the curve for affordability. When you look at the median sales price nationally, that number is hovering around 420,000, and Tucson is coming around about, today it's 353 as of last month's numbers, and I've seen that number bounce between 350 to 360. So that means that you're able to get a nice quintessential American home, a 3-bedroom, 2-bath for $50,000 to $70,000 below the national median number. And you take that with everything else that's nice about Tucson, good weather, if you can bear a couple months of the hot summer, and the beautiful mountains, it makes real estate in Tucson an absolute value. Now, what I see that's very unique about this is, I wasn't born in Tucson, but I've lived here almost my whole life, and I get to talk to clients from all over the country. And so when I'm talking to somebody who's not local, who's not from Tucson, they're moving from California or Washington or Seattle, and they're selling a condo for $1 million, and they look at these prices that we see, and they just see an absolute steal. But for those that are local, we were once a kind of a best kept secret, and you could get a 3-bedroom, 2-bath house not that long ago for 250 grand. So the locals have really struggled seeing the price continue to surge upwards with all these people relocating or migrating into Arizona. And so what that's done is it's caused our market to really stay relatively flat, which means that even when interest rates went from 3% to 8%, Tucson basically held its value. And what I see is a lot of the locals are holding off, waiting and hoping that prices might pull back. And you have people from outside, people migrating into town that just see it as an absolute steal, and they're very happy to buy a house at 350 or 400, 500, when it's the house from back home in California was a house half the size selling for twice as much. So what that's done is it's created a great opportunity for buyers. If you are one of the buyers in the market right now, you can take advantage of the fact that it really is a buyer's market, which means that there is enough listings on the market that sellers are competing with each other. And so as a buyer, you can get a pretty good deal on the price. It's not the market where you're going to steal a house for 20% below what they're asking, but what you can really get is you can get full concessions. And concessions are where you go and negotiate a credit from the seller, and that helps cover your closing costs. On a price that we just mentioned, $350,000, your closing costs will probably run around 2 to 3%. So you could have all of that covered by a seller credit, and you might even negotiate a little bit more credit to bring the interest rate down below market. And if you look at, that's what builders are doing, not just in Southern Arizona, builders are doing that all over the country, because with interest rates increased in the last few years, the best way to help you as a buyer in your pocketbook is to bring down the largest cost of financing a house, which is the interest rate. So in our market in Tucson, with it being more on the buyer side, smart buyers are leveraging houses that have been sitting for more than a month, and they're going in and they might get the price down a little bit, and they're getting a lot of closing cost credits, which saves them thousands at their closing table, and it can also save them tens of thousands in interest over time by reducing their monthly payment. Now, because there is this room to negotiate, there is one mistake that I see people make, and it is when they get so aggressive with just bringing down the price. So for example, let's say a house was sitting, they're asking $400,000, and you're negotiating to maybe take $10,000 off the price of the house. Well, the problem with that is if you're not planning to pay cash, or if you're not planning to pay that loan off in a short period of time, you would actually be better served taking that $10,000 credit, not as a reduction off of the price, but you're actually better taking that as a credit and using that to pay down the interest rate or buy down the interest rate. And the reason why I say that is when you look at your cost over the life of the loan of what you'd pay in interest, you're looking at sometimes a 4 to 5 times return. If you look at reducing that price by $10,000 versus taking that $10,000 and putting that towards buying down the interest rate, you might save $40,000, $50,000 over the life of the loan in reduced interest. So, not necessarily a mistake, but I think it's just math. And when people know that they're buying a house that they love, that they're going to keep for a long period of time, you're better off taking the credit than you are getting the price off the asking price of the house. Not to say you should overpay, but when you feel like you're at a good price and you've haggled down a little bit, I love investing in real estate, and I will always feel like I found the floor, the lowest the seller's going to go, and then I start negotiating credits if it's a property that I'm keeping. If I'm paying cash, always take it off the top. Now, of course, everyone's circumstances are a little unique, and every house tells its own story.